the Senior Manager in our Global Accounting Consulting Services Group. I'm joined today by Scott Bandura, our Global Oil and Gas and Mining Technical Accounting Leader. We're here today to talk about the new definition of a business, which is effective for periods beginning on or after January 1st, 2020. Scott, can you give us a brief overview of what's changing?
Sure. Well, there was often criticism of the previous definition of a business because it was considered to be too broad. So the standard setters have tried to narrow the definition somewhat. For instance, under the old definition, there was no need for inputs and processes necessarily in a particular operation acquired, as long as those were substitutable by a market participant. Now, under the revised definition, in order to qualify as a business, an operation will need a minimum of an input and a substantive process. The other major change has been the addition of an optional concentration or screen test, and this allows for a simplified assessment of whether a transaction qualifies as a business combination or an asset acquisition. And this optional screen test is selectable on a transaction by transaction basis. Basically, what this screen test says is if substantially all of the fair value associated with the acquisition is concentrated in a single identifiable asset or a group of similar identifiable assets, the transaction can be treated as an asset acquisition versus a business combination. Some things to note there, the standard says generally things like tangible and intangible assets are not similar in most cases, and then assets with substantially different risk characteristics also would not be considered similar in this context.
That was a great summary, but why does it matter if something's a business combination or an asset acquisition?
That's a good question. So there are various specialized accounting rules associated with business combinations under IFRS 3. So one of the major differences between an asset acquisition and a business combination is goodwill. Goodwill can arise only in a business combination, similar to negative goodwill. Goodwill is the residual interest after the identifiable assets and liabilities in a business combination are recognized, but there's no concept of goodwill for asset acquisitions. Transaction costs are also treated differently between a business combination and an asset acquisition. Transaction costs in a business combination are generally expensed, whereas in an asset acquisition, transaction costs may be capitalizable. Finally, another major area of difference is with deferred taxes. Deferred taxes are typically recognized in a business combination based on the temporary differences associated with assets and liabilities acquired. However, in an asset acquisition, there's a special exemption outlined in IAS 12 called the initial recognition exemption. So in some cases, temporary differences associated with assets acquired other than in a business combination are not recognizable on initial recognition.
Thanks for clarifying, Scott. But how does this change impact oil and gas and mining companies specifically?
Well, it's a good question, and I think in oil and gas and mining, there's always been a spectrum of transactions. So some transactions will have qualified as asset acquisitions and some as business combinations, depending on the stage of the operations, etc. I think we'll still have a spectrum under the new standard, so that spectrum may shift a bit, but generally speaking, there's still going to be some judgment in looking at various transactions as to whether they're an asset or a business combination. One thing the standard notes explicitly is that outputs are not always required for something to be a business. An organized workforce and other inputs can be sufficient in order for an acquired operation to be considered a business. And the standard notes that other inputs may, in this context, include a mineral interest. The other challenge, I think, for companies in this industry is how to apply the concentration test. For instance, in oil and gas and mining, we often see acquisitions that have both PP&E, property, plant and equipment, intangibles, and E&E, exploration and evaluation assets. And those E&E assets may be tangible and intangible themselves. We also see operations acquired with different levels of reserves. So there may be operations that have proven reserves acquired in a transaction, or operations or areas that only have probable reserves. Furthermore, in these types of transactions, we often see contracts for transportation, such as pipeline contracts, processing contracts, and other contractual arrangements that have to be accounted for. So the fact that there are all of these different types of assets being acquired can make it difficult to apply the screen test, because as you'll recall earlier, in order to apply the screen test, substantially all of the value has to be concentrated in a single group of a single identifiable asset or a group of similar identifiable assets. So if there's a broad disparity between these assets and different risk factors, etc., that can make it difficult to apply the screen test. I would say it's good for companies to start thinking about this now and early. Although, as you mentioned, the standard is not mandatory until 2020 for calendar year entities. Some companies may think about early adopting the definition. And companies generally are going to have to think about how their policies or approach to transactions may change. Will they want to apply the screen test to all transactions and try to use that screen test, or will there be certain transactions that companies don't elect to apply the screen test to? So that'll be an important consideration. I think obviously as we get closer to the implementation date and as things evolve in the market, we'll see an evolution of thinking on this. But again, I think it's worth companies being aware of this new standard and starting to think about its application early.
Thanks, Scott. Those are all my questions today. If you have more questions, you can always reach out to your PwC contacts or visit pwc.com.